Today, we are lucky enough to be having Luke Neff from the CFS Financial Planning Center joining us to give a Roth IRA Basics webinar. But before he dives into his actual presentation, I did just want to go over a few quick housekeeping notes. So if you have any questions throughout today's presentation, go ahead and use the Q&A button located in your Zoom webinar panel. You can type your questions, and Luke's going to do his best to answer those questions throughout the presentation. And any questions that are not answered during the presentation, he will address you following the presentation in an email. Reasons for this might be sometimes questions of a personal nature are asked, and those will be followed up with following the presentation. There are resources from this presentation available. You can use a link in the chat to get all the slides from this presentation, as well as view Luke's biography. And finally, for anyone viewing this presentation and webinar that is not a member of DAYAIR, you can learn more about one of the country's premier financial institutions located right in your own backyard at dayair.org, and you can join DAYAIR in less than 5 minutes using our easy online account opening. So without further ado, I'm going to now welcome Luke Neff in to give his Roth Basics IRA presentation.
Thank you. All right, thank you for joining us. We are going to talk about Roth IRAs today. Again, my name is Luke Neff. I'm a financial planner here at DAYAIR Credit Union. I do work with our members here to do financial planning and investment management. Today, this is just an educational webinar, and we're going to learn a lot more about Roth IRAs. And there's a lot of mechanics, a lot of moving parts to Roth IRAs. But before we dig into that, I want to talk just a little bit about what can you use a Roth IRA for? What goals can you try to accomplish with a Roth? Because I think at the end of the day, you know, we can learn about the mechanics, but the important piece is what can we use this tool to accomplish? So I wrote down a few goals, ways that we can use Roth IRAs. Number one, you can use a Roth IRA to lower your tax bill during retirement. And there's a couple of ways that we can do that. There's a couple of ways that we can do that. So for one, you can choose to take your contributions, or I'm sorry, you can take withdrawals out of a traditional, instead of taking withdrawals out of a traditional IRA, you can take distributions out of a Roth IRA, and if they're qualified, they're tax-free. You can also convert traditional IRAs to Roth IRAs, and in doing so, you can potentially eliminate or minimize required minimum distributions. A couple other things you can do, you can receive tax-free income. Obviously, if you're not paying taxes on the income, it's better than paying taxes on the income. Number three, you can use Roth IRAs to retire early. So in this case, with Roth IRAs, the contributions can always be pulled out early before age 59 and a half. And conversions, as long as they're held over 5 years, those can be taken out tax-free, penalty-free before the age of 59 and a half. Number four, another way that you can use Roth IRAs is to create a tax-free legacy for your family. The funds in a Roth IRA grow tax-free for your lifetime, and when your heirs inherit the funds, they can continue to let them grow tax-free for 10 years. And then lastly, you can use a Roth IRA as basically to shelter tax inefficient investments. So there's certain types of investments that are less tax efficient than others. And those would be like corporate bonds, high dividend paying stocks, REITs, short-term trading strategies, things like that. You can put those strategies inside of a Roth IRA and get tax-free treatment. So those are just a few ways that we can use a Roth. Now let's talk about how the Roth works and the mechanics of it. So Roth IRAs, as opposed to traditional IRAs, are made on an after-tax basis. This means that you're not going to get a tax deduction. There's no upfront tax benefit for putting money into a Roth account. However, qualified distributions are entirely free from federal income tax. So this is a huge benefit. The contributions and the earnings can grow and be withdrawn tax-free. At this time, all 50 states honor qualified distributions from a Roth IRA, so they should be state tax-free, but of course, tax laws can always change. So let's take a look at traditional IRAs and Roth IRAs and compare them to one another. And another fun fact before I do that, the Roth IRA was introduced in 1998, so it really hasn't been around quite that long, not as long as traditional IRAs. About 20% of US households are using Roth IRAs, whereas close to 30% of US households are using traditional IRAs. So I think that Roth IRAs are a bit underutilized. It's not that one is necessarily better than the other, but there's two tools and you can use them in conjunction together. So with traditional IRAs, actually both of these, you do have to have earned income in order to make contributions. Whether that's traditional or Roth, you have to have earned income, meaning you either receive a W-2 or you have self-employed income. So things like unemployment income or retirement income or Social Security income or pension income, that does not count. You would not be able to contribute from your checking or savings to a traditional or a Roth IRA unless you have that earned income. Now with a traditional IRA, most people put money into a traditional IRA, not just for the tax deferred growth, but also to get a tax deduction. You can get a tax deductible contribution into a traditional IRA. There are also non-deductible ones, but with a Roth IRA, there are no deductible contributions. You will not receive an upfront tax break. As far as distributions, all distributions from a traditional IRA are going to be taxed at some point, except for the non-deductible ones. Whereas the Roth, as long as they're qualified distributions, all the withdrawals, all the distributions will be tax-free. Traditional IRAs have a required minimum distribution each year when you turn 72 and later. And the percentage is around 4% a year. So just to put this in context, if you have an account with a traditional IRA with $1 million in it, you're going to be required to take out about $40,000 per year, which could significantly increase your tax bill. However, if you had that same amount of money in a Roth IRA, there are no required minimum distributions. You can let the money continue to grow tax-free, of course, until you pass. And if you do take distributions, those will also be tax-free. So with traditional IRAs, tax-deferred growth, Roth IRAs, mostly tax-free. It's tax-free as long as they're qualified distributions. And that's the key, the qualified. What does it take to have a qualified Roth distribution? So there's two rules that need to be met. The first is the 5-year holding period. And the second is to have a qualifying event. The usual qualifying event is age 59 and a half. When you're over age 59 and a half, the earnings are essentially tax-free as long as that 5-year holding period is satisfied as well. There are other qualifying events like disability, death, first-time homebuyer expenses. So let's talk about that 5-year holding period, because I think this one is less familiar than the 59 and a half qualification. So remember, we want qualified distributions. We want ones without penalties. we want distributions that are tax-free. So this 5-year holding period starts on day one of the first dollar that's put into a Roth IRA, whether this is a conversion, a rollover, or just a regular contribution. And that's when the clock starts. That's when that first 5-year window starts. So once that 5-year window is satisfied, then the earnings are tax-free. Of course, you do have to have a qualifying event as well, like age 59.5, death or disability as well. Remember that. But the 5-year period can be satisfied with your first contribution, even if it's only $1. And your additional contributions after that first one, they do not have new 5-year windows. So basically, that first dollar starts the clock. Once that's satisfied, it's really satisfied for life. Now, there are 2 different 5-year periods that need to be considered, but in this case, we're just talking about 1. So if we look in the green box, you can actually have a shorter than 5-year holding period. And the way this works is, for instance, if you put money into a Roth IRA through a contribution, let's say it was April 15th of this year, you could have designated it for a prior year contribution for 2020. And the 5-year holding period always starts on January 1st. So that's a year and 4 months that you just shaved off of that 5-year holding period. That is one strategy. So let's do this. We've got about three different examples here, and I want to go through these, and I think this will help us to understand how the 5-year holding period and the qualifying events work together so that you can get qualified tax-free distributions from a Roth IRA. So in this example, this saver is age 60, and they're putting money in the Roth IRA on December 31st of this year. They do need a qualifying event, and they have to satisfy that 5-year holding period. Okay, so let's take a look here. So let's look at the timeline here. The money was put into the account on December 31st of 2021. However, the 5-year holding period is always January 1st, so it's backdated. So the 5-year holding period starts January 1, 2021 and ends December 31st, 2025. So that means on January 1st of 2026, the earnings would be tax-free distributions. Now, I did say earnings would be tax-free. How about the contribution itself? Well, one unique feature of Roth IRAs are that the contributions are always tax-free. So no matter your age, if you are able to make a Roth contribution, you can always pull that money back out tax-free. So in this case, the qualifying event is 59.5. So that means that there's no 10% penalty for early withdrawals. And then the earnings you would need to wait until 5 years to withdraw the earnings. So let's just do a for instance scenario here. The deposit of, let's call it $6,000 on December 31st is put into the account. If this gentleman wants to pull out his $6,000 anywhere before the 5-year period, that's okay. That is tax-free. However, if that $6,000 grows to, let's say, $8,000, and this person wants to pull out $8,000, the $6,000 would be tax-free, and the $2,000 of earnings would be taxable, but not subject to the 10% penalty. So let's move on to example number 2. All right, in this instance, this saver is age 35, significantly younger, makes a contribution through a rollover from a retirement plan. We're looking for a qualified event and satisfying the 5-year holding period. Okay, so let's take a look at this scenario. The funds are converted from the 401k retirement plan June 1st. Of course, the 5-year period is backdated to January 1st. Remember, January 1st is always the start of the 5-year holding period. After 5 years, the conversion amount, let's just say it was $10,000 that was converted, that can be withdrawn tax-free. However, any earnings, any interest made on that money would be subject to a 10% penalty plus ordinary income taxes if there was no qualifying event, like age 59 and a half, or death or disability, or using it for a first-time home buyer expense. Let's look at example 3. You inherit a Roth IRA, and this was established in 2018, but the 5-year holding period has not been met yet. So let's take a look at how this works. So the Roth IRA was established in 2018, and then 3 years later, your mother passed away in this example. What happens if money is pulled, if the contributions and earnings are pulled out of the account before the 5-year holding period in this case? Well, since it's inherited, death is a qualifying event, so there's no 10% penalty. So the 10% penalty does not apply. And the contribution is tax-free, so that would not be taxed either. However, the earnings, any earnings in the account, you would have to pay ordinary income taxes until the 5-year holding period is satisfied. And this is important because, you know, at the top tax rate, your federal tax rate can be up to 37% federal tax rate. In Ohio, the maximum state tax rate is close to 5%. So now you're talking 42%. And then you can also have a 10% penalty on top of that, not in this case, but that would get you to 52% taxes. And we want to avoid that as much as possible. Okay, so let's take a moment and talk about non-qualified distributions. And looks like there is a question. Yes, so the question is that once you're over age 59 and a half, are there any other qualifying events that need to be satisfied in order to take a distribution tax-free? So the answer to that is no. You only need one qualifying event. So it's either age 59 and a half, death, disability, or first-time home purchase. The 5-year holding period, though, is to satisfy the earnings. So there's no 10% penalty, but you could pay ordinary income taxes even after age 59 and a half if the 5-year holding period is not satisfied. Okay, so let's talk about non-qualified Roth distributions. So there's so obviously qualified is better than non-qualified, but one neat thing or very advantageous thing about Roth IRAs is the ordering of which withdrawals come out of the account. So the first there's 3 different types of funds in a Roth IRA. Number 1 is the contributions made. So the contributions are it's money that you took out of your checking or savings account and put in the Roth IRA. Secondly are conversions. Conversions are money that's converted from a traditional IRA or some kind of 401k retirement plan. And then thirdly are earnings. So remember, there's two types of funds in a Roth IRA: contributions, conversions, and earnings. Contributions come out first, then conversions, then earnings. This is a very advantageous order. So the contributions are always going to come out tax-free. So the first dollars that you take out of a Roth IRA are contributions, and those are tax-free at any age. You don't need a qualifying event for that. Earnings come out last. So the earnings can be subject to a 10% penalty unless an exception applies, which we just discussed. How can we fund a Roth IRA? Well, contributions, conversions from a traditional IRA, and then you can actually roll over retirement plans like 401ks, 403bs, deferred comp, TSP. There's a number of other plans, retirement plans from work that can be rolled into a Roth IRA. So let's talk about funding a Roth IRA through contributions. Well, you can put $6,000 per year into a Roth IRA currently. And if you're age of 50 or older, there's a catch-up contribution of $1,000. So that's $7,000 total that could be put into a Roth IRA from a checking or savings account. There are limits based on income and filing status. So let's just take a quick look here. So in 2021, this year, if your modified adjusted gross income is below $125,000 and you're filing single or head of household, you will be able to maximize your Roth IRA. You will be able to put the maximum amount in. If it's between $125,000 and $140,000, you will be limited on the amount that you can put into a Roth IRA. And if it's over $140,000, you're not going to be able to put anything into a Roth IRA. So what can you do if you're a higher wage earner? Are there ways that you can either reduce your income, or is there maybe a backdoor approach to getting money into a Roth IRA? So yes and yes, and I'll address those. I'll address the backdoor Roth IRA a little later in the presentation, but here's a couple suggestions to lower your household income that may get you into a place where you can put money into a Roth IRA. If you have an employer plan like a 401k or a 403b or a TSP plan, deferred comp, any of these plans, you can put $19,500 into those workplace plans, and this will reduce your taxable income. If you're over the age of 50, you can put an additional $6,500 into those plans. That's $26,000 a year that you could reduce your income that could potentially get you to a place where you can put money into a Roth IRA. Not only that, there's high deductible health plans. And if you have one of those through your workplace, you'll also be eligible to put money into a health savings account, which could be between $7,000 and $8,000 in additional tax reduction or income reduction to get you closer to being able to qualify for Roth contributions. So those are just a couple ideas to help. Now, converting a traditional IRA to a Roth IRA, this is absolutely something you can do, and there's different strategies to do it. So the question is, well, how is it taxed? It's taxed as ordinary income. So if your tax rate is 22% federal, then you will be taxed at 22%. It's that simple. However, there is no 10% early distribution penalty. So the trade-off here is that you will be immediately taxed on the money that you convert. If you take, for instance, $10,000, convert it from traditional to Roth, tax-free status, you are going to pay $2,500. Well, 22% federal, 3% state estimate, 25%, you'll end up paying about $2,500 to convert it. So it may or may not be in your best interest, depending on what your tax bracket will be when you do retire, which we will get into a little later. You can also convert simple and SEP IRAs as well. How can you convert? How do you convert money from a traditional to a Roth account? There's 3 different ways that you can do this. You can do a rollover where you take possession of the funds, you do a withdrawal from a traditional IRA, and you roll them over to a checking or savings account. Now, you do have to get that money back into the Roth IRA within 60 days, or it will be taxable and subject potentially to penalties. Another issue that comes up is you can only do this once every 365 days. If you do 2 of these within a 365-day period, you're going to void both transactions. You'll owe the taxes, potentially penalties, and then also if you have to take the money back out of the Roth IRA, which you very well likely would, you're going to pay taxes on any earnings essentially at that point. So the best way to convert money from a traditional to a Roth is through a trustee to trustee transfer or same trustee transfer. And all that means is that the traditional IRA custodian sends the funds directly to the Roth IRA custodian. Or if they're the same custodian, if it's day or credit union, we'll just do it for you. Very simple process. And you won't have to worry about the 365 days or a 60-day period. It's just going to be taken care of. And you can do that as many times a year as you want. So how do we calculate conversion taxes? Well, again, it's your ordinary income tax rate, so that's pretty straightforward. However, if you were to convert money from a traditional IRA to a Roth IRA and you did not wait 5 years, you would pay 10% penalty on that conversion if you were to pull it out early before the 5 years. If you wait at least 5 years, you could pull that conversion out without paying tax on it, which is a way that you can essentially get money out of your Roth IRA before age 59 and a half. That can help you to potentially retire early. So most of the dollars, and I would say 99% of the time, traditional IRAs only have deductible contributions and earnings, meaning you got a tax deduction when you put the money in. So when it comes out, you're going to have to pay taxes on it. So the calculation is easy. Every dollar that you convert gets taxed. However, there are situations where there are non-taxable, non-deductible contributions, and this could be through rollovers from employer plans, or if you're in a higher tax bracket and you're not eligible for deductible IRA contributions, you may have made a non-deductible contribution at some point, and that would be you would actually not have to pay taxes on that money when you take it out. The issue is that when money is converted or just regular ordinary distributions from an IRA, it's just distributed on a pro rata basis. So if 90% of your, let's just say you have $100,000 in an IRA, 90,000 is taxable, 10% is non-taxable, and you want to convert $10,000, you're going to pay taxes on $9,000, but the $1,000 can be converted tax-free. And another thing to remember is that if you have multiple IRAs, let's say you have one traditional IRA, but you're going to make a non-taxable, non-deductible contribution into the traditional IRA in the hopes that you'll be able to convert that money to a Roth IRA without paying taxes. Well, the problem is you can't just open a separate IRA to do that. all of your traditional IRAs are aggregated together. And what this means is that you're going to pay taxes when you try to convert it. So who can contribute to a Roth? Actually, looks like we have a couple questions, so let me take a look here. Okay. How do we roll over a 401k to a Roth IRA? This is something that you can absolutely do. It's fairly easy. What you do have to do is notify the 401k custodian of what your intentions are, and you just literally you open a Roth IRA account and you tell them, I want to move X amount of dollars from my 401k to a Roth IRA. However, just remember you will pay ordinary income taxes, so you do want to talk to either a CPA or a financial professional and make sure that's a good idea. And then there's another question here. How do we start a Roth IRA for a 15-year-old? Well, minors can have a Roth IRA, but they do have to have earned income. Remember, they have to have W-2 wages or self-employed income. You cannot just open a Roth IRA and put money in there without earnings. So if the minor has, let's say, $3,000 of income for that year that they're reporting, they can only put $3,000 in the Roth IRA. If they have $6,000 of earnings for the year, they could put up to $6,000 for the IRA. And of course, you could get the funds to the minor, in which you're helping them out to start the Roth IRA. But if they do not have any earned and reported income, then they cannot. You cannot start a Roth IRA for somebody that's 15 years old, or a minor. There's a second question here. Would increasing my contributions to my 401k while I'm working benefit me differently than starting a Roth IRA? Well, absolutely, it would. It would benefit you differently. So unless you pick a Roth 401k, which by the way, some employers do have, most 401ks are traditional, meaning you're not paying taxes on the income that you're making because you're deferring it, you're putting it into your 401k. However, if you choose not to do that, but you choose to get taxed on it, the money goes to your checking or savings accounts paid out to you, and then you choose to put it into a Roth IRA, well, in this case, you've already paid the taxes, so you're not going to get a tax deduction. But the benefit here is that the money will grow tax-free for essentially until you pull it out for a qualifying event. One is not better than the other, but they should be used in conjunction, in concert with one another. So who can convert a Roth? Any traditional IRA can be converted to a Roth. However, you do have to pay taxes on it, except for inherited traditional IRAs. Inherited traditional IRAs cannot be converted to a Roth. However, there's one exception. If it is a spouse that inherited the traditional IRA, they can assume the IRA as their own, put it in their name, and then they can convert it because now they own the funds in that Roth or in that traditional IRA. So let's talk about the backdoor Roth option for a moment here. So if you are phased out, if your income is higher than the limits that we discussed before, for single individuals, so over the 125,000 for single individuals, what can you do? Well, if you don't already have a traditional IRA, you can create a new traditional IRA. you can make a non-deductible contribution into that traditional IRA, and then you can immediately convert that Roth IRA or that traditional IRA to a Roth IRA and pay no taxes on it. This is called the backdoor Roth option. And the reason this works is because there's no income limits. You can always put money into a traditional IRA. Now, your income needs to be below a certain threshold to get a tax deduction for it, but you are allowed to put money into a traditional IRA no matter what your income is. And there's also no limits on, or no income limits on conversion. So you can convert as much as you want in any tax year that you want. So in this case, you're making a non-deductible traditional IRA contribution, and you're immediately converting it to a Roth IRA to get money into a tax-free status. This is a great option. Now, here's something that there's pitfalls to this, though, that people need to be aware of. If you already have a traditional IRA, let's say you have $54,000 in a traditional IRA, and then you contribute $6,000 to that traditional IRA as non-taxable. When you go to convert your $6,000, they're going to aggregate your whole account together through the IRS, and essentially 90% of your conversion will be taxable. Only 10% of it will be non-taxable conversion. So just keep that in mind. And it looks like we have another question. All right, this one's a little bit more specific to this individual, so I will answer that in an email. All right, so converting employer plans, this was a question earlier. Yes, you can convert 401ks, 403bs, 457 plans. You can convert almost any employer plan to a Roth IRA. Again, sometimes this is advantageous and sometimes it's not. Let me tell you, there's a couple pitfalls that I see that people get into. Let me just say this. What I see often is 401ks or 403b plans move to a traditional IRA. And often in those retirement plans, there's non-taxable after-tax contributions. Instead of breaking those out into traditional and Roth, they roll them all together into a traditional, in which you don't get access to the after-tax money unless you empty the account. So the idea, what you want to do is if you have after-tax contributions in a 401k, 403b, you want to break those out separately. You can have those paid out in cash and then roll them over into a Roth. Or some custodians will roll it directly to the Roth and roll the other funds to the traditional IRA. But you are always, you are allowed to do conversions. You just want to let your employer know what you're doing. We do these fairly regularly here, so it's a fairly easy process. Just remember, you are going to pay taxes. You are going to pay taxes when you roll over the money from a traditional to a Roth. Because remember, you're moving money pre-tax to after-tax. So the IRS is going to get paid at some point. It's just a matter of whether you want to pay them now or later. This is I will tell you one other unique feature of 401ks, 403bs, retirement plans. Even if it's an inherited account, you can still convert it to a Roth. Whereas if you inherit a traditional IRA, you cannot convert that to a Roth. So different rules apply. Okay, so we're getting towards the end here. I know that was a lot of information, but there are pros and cons to Roth IRAs. Sometimes traditional IRAs are better to use. and then Roth IRAs maybe at a later date. So the pros for a Roth IRA are that if you expect to be in a higher tax bracket when you retire than you are currently, then it makes a lot of sense to go ahead and pay a lower tax rate now than a higher tax rate later. So you could pay your taxes now, let the money grow tax-free, and pull it out later without paying taxes. So the qualified distributions are tax-free. And a lot of people don't know this, but Social Security can be taxable. If your income is above a certain limit, which is not that high of a limit, up to 85% of your Social Security can be taxable. However, if you have a Roth IRA and you're using your Roth IRA for income and taking distributions, it will not affect your Social Security taxability. You also do not have required minimum distributions at age 72 or beyond. You could actually let that money continue to grow and compound at a tax-free rate for as long as you live. So you may be able to leave additional funds for your heirs on a tax-free basis. As far as cons, as far as negatives to a Roth IRA, well, if you expect to be in a lower tax bracket when you retire than you are now, then converting money from a traditional to a Roth may not make sense. It may make more sense for you to contribute money to a 401k plan. However, once you do retire, there's nothing stopping you from converting after you're already in that lower tax bracket from the traditional to the Roth. So that is a strategy that you can utilize. Now, if you need the money soon, it may not be appropriate to put money into a retirement account. I think that's self-explanatory. And of course, future laws can always change. So before we end here today, I just want to reiterate, why do we want to use Roth accounts? What are some goals that we can use to accomplish? So I mentioned these earlier, but I just want to mention them again. You can lower your tax bill during retirement. You can take tax-free distributions from a Roth instead of a traditional IRA. You can even convert traditional funds to a Roth IRA, thus avoiding the required minimum distributions that you would have to take otherwise. You can receive tax-free income. You can use the strategy to retire early. So remember that there's three types of funds in a Roth IRA. There's contributions, there's conversions, and then there's earnings. The contributions are always tax-free. They can come out first. The conversions, you just need to wait 5 years before you take money out from when you first converted, and that's tax-free. And then the earnings are the only part that you do need to wait until 59 and a half to pull out. You can leave a tax-free legacy for your family, tax-free growth for your lifetime, and then an additional 10 years after you've passed. And then lastly, you can use a Roth IRA to shelter inefficient investments like corporate bonds, high dividend paying stocks, real estate, and short-term trading strategies. So with that being said, let me take a look here and see if we have any additional questions. Get rid of that laser pointer there. All right, so I'll give you just a moment. Are there any additional questions before we conclude? Okay, got a couple coming in here. Okay, can contributions be made monthly, or does it have to be just once a year? You can absolutely do monthly contributions. That's not a problem. And frankly, you can do monthly and then you can do lump sum contributions. We have clients here that do that as well. The key here is that you don't want to go over the limit. So if you're under 50, the limit's $6,000 a year. If you're over 50, it's $7,000 a year. And just remember, you do have to have earned income to be able to contribute. All right, well, at this time, that will conclude the webinar. If you need any additional information, if we didn't answer a question, or if you thought of a question afterwards, please do reach out to us here, send me an email, give me a phone call. If you'd like a complimentary consultation, we can also set up an appointment. Thank you again, and have a great day.